Thank you, Jerry. Good morning. The title I think worked out, given that we had the news yesterday about the president being impeached. So it was very fortuitous, I guess, that we may be in a year of living dangerously. It comes from a 1983 movie starring Mel Gibson, Sigourney Weaver. It's about the 1965 Indonesian Revolution, where about 900,000 people got killed. So hopefully it will not be as dramatic as that, but it is a very good movie if you could get it on Netflix or one of the streaming services. All right, our theme today is we think, as we've been saying for about over a year, the economy is slowing. We're downshifting to about 2% this year, 1% in 2020, and we still have a high recession risk for late 2020. The slowdown is being caused, and this is in the data, by the waning of the 2017 tax cuts, trade tensions, slowing business capex, soft housing, but I'll get back to it. The recent housing data of the past month has been better than what we thought it would be, so housing may be a little bit better. I'll go into that in a bit. Weaker employment growth, and a flat stock market basically for 20 months or so, since 2018. But that weakness, we don't get a recession because that weakness is offset by still very strong consumer demand, fueled by real wage growth. There's very strong government spending, both defense and non-defense. And we have a technology-induced intellectual property boom going on. And by intellectual, the key drivers there are cloud computing and streaming video for TV and filmed entertainment, which is all over Los Angeles right now. And with inflation hanging around 2%, the Fed has sort of changed its view in the past 3 or 4 months. And we think the Fed's going to be aggressive in the sense that the Fed funds rate, if our forecast is right, may be as low as 1 1/8 by the end of 2020. I'll go into the rate outlook in a bit. So we think the Fed will be more aggressive than, this is what the markets were thinking in August. The markets probably are saying 1.375 for year-end 2020. So we're a little bit more aggressive than what's in the forward markets. Here's our GDP outlook, where we had 3%, 2%, slow, just under 2% the next couple of quarters, a little more in the first quarter. And here's the recession risk, where we go below 1% in the third and fourth quarters of 2020. So Wall Street was really worried in August when the market freaked out, the curve inverted, and I'll go into that in a bit, that the recession was coming, not a year from now, but the recession was coming in September or October. We never bought into any kind of recession in 2019, and it's probably, if we're going to have the risk, it's probably sometime in 2020, not in 2019. All right, we're also in an environment where we're with a trade war environment, and the president today, in order to change the topic, said we're very close to a deal with China. That's what he said today. And the market, which was down in terms of Dow points, was down like 50 or 60, all of a sudden turned around and was up 150. I mean, I don't know where it is now, but he sort of changed the topic and said maybe we're close to a deal with China. And you have to remember, we had extraordinarily bellicose rhetoric coming out of him at the UN yesterday. And the trade war, here's the impresario of the trade war, and who's going to pay for it? It's the U.S. consumer. The tax coming from tariffs is worth $70 or $80 billion a year, and it's a tax on consumers, it's a tax on American businesses, and it's a tax on American consumers. And that basically, all things being equal, is you'll get higher inflation and you get lower output because it puts friction in the gears of commerce. And we have the trade war continuing. We don't have a truce in the trade war. If there's a genuine truce, our outlook would be improved. All right, so that remains to be seen. Now, here's the thing about trade. Fed Chairman Jerry Powell said, moreover, while monetary policy is a powerful tool that works to support consumer spending, business investment, and public confidence, a statement that my friend, the distinguished Professor Mr. Leamer, does not agree with, but the Fed believes, but this party would agree, it cannot provide a settled rule book for international trade, which means the Fed doesn't know what to do. It's very hard to model a trade war. And the reason is we haven't had any real experience with a trade war for about 90 years. The last time we had a trade war was in 1930 with the Smoot-Hawley tariffs, and that didn't end all that well at that time. So the thing is the Fed is flying blind, economists are sort of flying blind because we have no real recent history to come up with any kind of serious econometric forecast. We can make a whole bunch of assumptions, we'll put our garbage in, we'll get garbage out, but we have no real data to basically say what will happen as this transpires, and that puts a whole level of uncertainty on the economy. So the Fed is admitting it doesn't know what to do on this. Okay? That's the admission from the chair of the Fed. All right, despite the tariffs, and the whole purpose of the tariffs is the president wanted to lower the trade deficit. That's his big objective. He doesn't, especially the bilateral deficit with China. Trade deficit is still going to go up. Trade deficit in real terms, this is real net exports, is going to be over $1 trillion. So it basically, if the United States basically consumes more than we produce, we've got to import stuff from someplace else, and that's the trade. That's the trade deficit. And it's not going to change with a tariff, because if we don't get it from China, it's like squeezing on a balloon. We'll get it from Europe, we'll get it from Mexico, we'll get it from Vietnam. It wouldn't necessarily be from China. All right, what the trade uncertainty has done is it has really slowed equipment spending. And if you take a look in terms of equipment spending, the last 2 quarters, nothing, zero. Current quarter looks like it's going to be negative. Fourth quarter is negative, but we got a big bulge in the first quarter of next year. And here we make a heroic assumption that the 737 MAXs, which are being produced right now and going into inventory, are going to get shipped. That will affect exports. It comes out of inventory. It doesn't add a whole lot to GDP, but we're making an assumption that it is going to ship in the first quarter. Now, United Airlines say they're not going to fly 737 MAXs until like December 20th or something like that. Southwest says January 2nd. If you go to their websites, all I know is that's what they're saying. So the thing is we're making an assumption it's the first quarter. If it's earlier, it'll move up. If it's later, it'll move back. If it's not at all, then we're not going to get the bulge. We're going to have a much bigger problem on our hands. And then a major U.S. company will really be on the rope. Boeing will really be on the ropes, and that's our #1 exporter. So we're making the assumption it's first quarter, but my guess is as good as yours on that. We haven't had any real news from FAA or anybody. The only thing we've heard was that it'll be a country-by-country decision from the FAA. So the U.S. may approve, but the EU may not approve. Indonesia may not approve. It's going to be country by country or authority by authority decision. The other thing that's been weak is business investment in structures. That's already weak. We had a very weak in the fourth quarter. Now, a lot of this is energy, oil related, because a third of this sector has to do with energy, oil and gas production. So when people think business and structures, you think office buildings, shopping centers, and what have you. A lot of it is power plants and offshore drilling rigs and fracking in the Permian Basin. And that's been weak, and the drop in the second quarter is a response to the drop in the price of oil from $75 down to about 52, to around $52 before the recent rally due to Saudi Arabia. And we have this sort of week going forward because commercial construction is also leveled off. So if you sort of have flattish oil and gas, flat to down commercial construction, you have a negative number here for many quarters ahead. So business investment in terms of physical goods is really weak. So in a sense, you could say is a business recession. We're in the beginnings of what you would call a manufacturing recession right now, but not an overall recession because the consumer is fine. Now here, the thing is that freaked out all of Wall Street is the negatively sloped yield curve, and this is the 10-year Treasury. This is the 10-year Treasury minus the 3-month Treasury bill. And if you notice in the chart, curve inverts, a year later, recession. Curve inverts, recession. Curve inverts, recession. And the thing is, this is an indicator. Also could be an estimate of Fed policy, because the market is saying the Fed's got to ease. But why has the Fed got to ease? It means the Fed's worried about maybe weakness in the economy. Or it also could be a cause, in the sense is that the arbitrage profits that banks make from borrowing short and lending long, the margins are much thinner. In fact, they go negative, so banks get more reluctant to lend in this environment. But this is a signal, and it's important. This is what Wall Street's worried about. And it also says, when the curve inverts, you don't necessarily get a recession right away. It could take a while. And you could go back, and you'll see this pattern repeats a lot. But I'll go into a little bit. This inversion is different from prior inversions, and I'll go into that in a bit. The other thing that's forcing our long-term interest rates down is we have negative yielding sovereign debt around the world, about $16–17 trillion. When I did the slide, it was 16 trillion. If I did it yesterday, it would be 17 trillion on it. And you take a look, is you have in France, 10-year money, minus 17. 2-year money, minus 67. Basically, you have to pay France to borrow money. They don't pay you, you pay them. And you take a look at Italy, for 2 years, Italy is not the greatest credit in the world. For 2-year money, you got to pay them 16 basis points to borrow money. And I asked Ed, since Ed's been teaching economics since Adam Smith probably. He was Adam Smith's pupil, I think. And I said, do we have in the textbooks, and all the times he taught economics in the textbooks, did anybody ever really discuss negative interest rates? And the answer is no. So this is a new phenomenon. Basically, what the ECB is just buying up every bond in sight. The Bank of Japan is buying up every bond in sight. That's putting pressure on it. And also, people have some view on the exchange rate between the dollar and the euro, or the dollar and the Japanese yen. But the thing is this is an unprecedented environment. And essentially, what you're doing is you are paying the sovereign, say the German government, to store your money. Now, if you had 300 euros, you could put it under your mattress. If you had 300 million euros, you need a very big mattress. So you have somebody has to pay to store it. And basically, the government of Germany is charging a storage fee to the banks and everybody to store the money. The problem is it really messes up the banking system. And you take a look at all the European banks. Their stocks are down like 60 or 70% in the past 2 years, even if you throw out Deutsche Bank, which is a basket case on its own. Now, we think we're in a Fed rate cutting cycle. And see what's happened here, which is really different, is the curve really starts inverting when the long bond yields start dropping. It's not so much that the Fed is raising rates. The trigger on the inversion over here is the drop in the 10-year rate. And this is viewed more as a friendly flattening rather than an unfriendly flattening. And the drop in rates is coming from the real weakness in Europe and the severe negative interest rates in Europe. And that's putting basically an anchor on our rates. So it's hard for us to see a rise in rates until we begin to see some positive rates in Europe. And what's being suggested for Germany and France and some of these countries is a big fiscal stimulus. Fiscal stimulus is have them run deficits, will supply the market with more bonds, and then maybe we'll get positive interest rates in Europe in 2021. Hence, we have long rates going back up in 2021. And we have the Fed continuing to cut, first because they're worried about weakness in Europe and the trade war. Inflation is benign. It is benign, and so we have rates going down to 1 1/8 in the fourth quarter of 2020, and then gradually going back up again. Part of the reason why the Fed could do this is inflation is sort of locked in around 2%, which is their target. We have it a touch above it. The core inflation is the dotted line, which is ex food and energy. The headline inflation is total inflation. Okay, here's our employment growth. We have employment growth slowing, but then we get a bulge in the first and second quarters of 2020. That's the federal government hiring part-time census workers to go around and count. So if you don't fill out your form, when you'll get the form in the mail roughly in March of 2020, and you don't fill it out, the federal government sends somebody to knock on your door. And they got to make sure somebody's there to get somebody to fill out to fill out the form. And they hire several 100,000 people to do this, so we get a surge in employment. And then part of the drop in the second half of 2020 is this, we no longer need the census workers. They've done their job. And so these part-time workers leave the employment force. So if you back out the census effect, we only have the fourth quarter's down a little bit. The third quarter's employment's up. So it's not, the surge isn't for real in a sense, and the drop isn't as real. It doesn't look as bad as it looks. But that's going to show up in the data. So you're going to see a report, say when they issue the report in April, and they're going to say, we added 500,000 jobs in March. But then you have to see through the headline, because of that 500,000 jobs, 350,000 of them will be part-time census workers. So you have to have that in the data because they count, even though they're mostly part-time workers, but they're full-time workers. And with full employment, you say, where are we going to get these? And they'll probably get it from a lot of retirees who are going to work part-time to do this. And that's where they're going to get the people. The other thing is in the employment reports, this is the history. The BLS told us that in March, there were 500,000 less people working in the United States than they had thought. They haven't readjusted all the numbers for that, but that's going to lower on average employment growth between March 2018 and March 2019 by 40,000 jobs a month. So the real numbers have been weaker than what's been reported. So I have to point that out. So when we do this and we have the March forecast, we have all the full data, you're going to see lower employment gains in the history. So where economists is, first of all, we have the issue, we got to forecast the future, but right now we really can't forecast the past all that accurately either until we get the new data. All right, in this environment, we have unemployment bottoming roughly where it is, and then rising a little bit to 4% as the economy slows, and then flattening out there. And housing starts, we had this range bound, right, basically around 1.2 million, but we had the best housing start number since 2007 was reported last week at 1,350,000. We had very good home sales numbers today. We had very good existing home sales numbers announced 2 days ago. So our sense is we were just we were waiting and waiting for the housing market to respond to the big drop in mortgage rates. And nothing happened. And then we wait another month. Nothing happens. And nothing happens. So we just assume nothing's going to happen. Maybe housing's ignited. So if we're wrong here, and we get another month to confirm what's been going on, or another 2 months to confirm, we would mark up our housing forecast in December, and then the second half of 2020 will not be as bad as what we're showing here. So if you want to hang your hat, something more on the upbeat side is housing has a big potential to surprise on the upside, where in the past it's been surprising on the downside for the past several years. It may finally begin to surprise on the upside. So that's something we're watching very closely, and tune in December to see where we come out on that. And the other thing that's been the reason why we're sort of pessimistic is that the stock market hasn't done anything since January of 2018. And the thing is that's when Trump started talking about tariffs. That first big drop after January is the introduction of tariffs. And the thing is if there's a real trade deal, the stock market probably will act better, because the stock market responds to good trade policy and bad trade policy. But the market, the S&P was 2850 in January, in January 2018. It was like 2950 yesterday. So over 21 months, it's up a couple of percent. It's basically a flat stock market for 20 months. Now, what's working is wages are going up. We may be 5% year over year by the end of the year. We have them around 3.5% year over year going forward. If you have that and 2% inflation, you have real wage gains of 1.5%. That's a big support for consumption. We had a great first quarter. We don't think we're going to sustain 4.5% that we had in the first quarter. So maybe we'll be in the twos. We have a drop off at the end of 2020. But consumption, if you want to tell a story of recession, you got to tell a story where you get consumption going negative, because consumption is 2/3 of the economy. So the business side of the economy maybe is keeping the economy down, but the consumer still remains very, very robust. Now, and then the other thing that's supporting the economy is the budget deal. Is we're getting 3 years in a row of 3% increases in real federal purchases. and that's both defense and non-defense. We have it flat in 2021. Who knows if there is a new administration, that number could be a lot higher, but who knows? If the current administration is re-elected, you might have a negative sign on that number, but we'll wait and see. And the thing is, this is an environment where deficits are $1 trillion and they stay there forever. And one of these days we'll worry about the deficit, but with 10-year treasuries at 160, no one is worrying about the deficit. There's no reason to worry about the deficit. Ed worries every night about the deficit. And one day those worries will come into fruition. And this is sort of the theme of the conference today is intellectual property spending. Very, very, very strong. It's going to stay above 4%, roughly for the forecast horizon. The impetus to go to cloud computing, to streaming video. Streaming video is going to hit the wall, whether it's going to be late next year or the year after that, is because there's not enough hours in the day to watch all the stuff that's being streamed and coming on all these services. So that's going to hit the wall sometime, but I don't think it's this year. I don't think it's next year. And then there was an extraordinary breakthrough the other day where Google developed a really working quantum computer, and that could be a whole new ballgame with respect to technology. And then to close is we have 2020. It'll be a dangerous year. We don't have a playbook for a trade war. Recession risk is high. Inflation stays at 2%. The Fed cuts. Unemployment stays low, but gradually goes up in 2020. And then we get growth resuming in 2021, so we sort of skate by. So that's sort of the forecast. And let me just close. The upside risk is housing may be better than what we have it here. Let me leave you with that. Thank you.